There's a lot of silver outside the LBMA and the Comex system. The idea that the shorts are going to catch the banks and drive the price of silver to $250 or $300, those guys they're smoking bad dope. That's not the way the exchanges work. Supplies are ample. What is missing is retail denominations. The other circumstance where the disparity between the volumes in the futures market and the good delivery inventory available to secure those would appear to be at a crisis point. It works for 2-ton buyers or 3-ton buyers, cash buyers. It doesn't work at the retail level. If I'm correct, the absolute purchasing power of the US dollar declines by 75%. It makes perfect sense to me that the US dollar price of gold would mirror the decline in the purchasing power of the US dollar, where over 10 years, the nominal price of gold goes up threefold or fourfold.
Welcome to the Microscopic Podcast presented by Gold Republic. My name is Alexei Joranov, and in this format, I invite you to look at the world through different lenses to see what's hidden in plain sight. I hope you will get fresh insight and enjoy this conversation. If you do, as always, please give it a like and subscribe, but also leave your actions down below in the comment section and share it to those who need to hear this. But before I start, I'd like you to know that if you open an account at Gold Republic, you will receive 1 free gram of gold. Just click on the link in the description. Today, I have the pleasure to welcome back Rick Rule. It's a pleasure to have you.
Pleasure to be with you, sir.
We've been just seeing all-time highs after all-time highs, especially in gold and also silver falling. What are your perspectives on, let's say, the markets and most importantly, how you would assess the bond market at the moment?
I wouldn't be a participant in the long bond. I just wouldn't do it. I've been fairly widely quoted, I think, as suggesting that the absolute purchasing power of the US dollar will decline by 75% over the next 10 years. If you believe, as I believe, then you adopt the same techniques that worked the last time the dollar fell by 75% in purchasing power, which was the 1970s. And the long bond got slaughtered in the 1970s. I own a lot of short-term bonds, 1 year, 2 year durations, but I wouldn't go out longer than 2 years in duration unless I had a source of capital that was cheaper than, in other words, unless I could do a credit spread. I have zero interest in the long bond.
Clear. And gold has now surpassed US Treasuries in terms of percentage of reserves globally. When we look at the dollar, the Dixie has also reduced, been in downturn since the beginning of the year by about 10%. Do you expect a further decline of the dollar this year and in the coming year?
I don't know about this year. I suspect over 10 years that the dollar will do okay against a basket of other currencies. My friend Doug Casey is famous for saying the US dollar is the worst currency in the world with the sole exception of all of the others. And all of the ills that I see plaguing the US economy, or at least most of the ills I see plaguing the US economy, I see plaguing other economies as well. Too much political power, misallocation of capital, too much debt. I think the absolute purchasing power of the US dollar falls by 75%. I suspect 10 years from now, if you compare it with the euro or the yen or the Canadian dollar or the Australian dollar, the US dollar will look okay. I think we're heading into a period of currency volatility. And I think the decline that you've seen in the dollar versus other currencies is a function of the eroding market share as a reserve currency, rather than a comment on the competitive valuations between economies in various countries. The U.S., For all its sins, and I'm American, I know the sins. For all its sins is still 23% of the world's savings and investment assets, and it is still the deepest, most liquid, and some could argue the most innovative economy in the world. It's also an economy whose voters and government are strangling themselves.
Would you say that this is due to the rise of gold again and to the remonetization of gold as a neutral reserve asset?
Yeah, I do. I think foreign central banks have been, in effect, forced into gold for two reasons. The weaponization of the US dollar, the idea that the US government seeks to superimpose its political preferences on people around the world via the SWIFT banking system, US sanctions, or in the case of Russia, as an example, simply stealing their US dollar denominated assets means that countries that think that they might have a policy dispute with the United States are thinking again about storing their wealth in an instrument that the US government can cancel at its whim, like it did to the Russians. The second thing is that the US dollar, or at least the US Treasury, is a lousy deal. If you believe, like I do, that arithmetically the decline in the purchasing power of the US dollar isn't measured by the CPI, which I think is a silly index, uh, but rather declining at some much greater rate, I believe 8% is an example, then the value associated with the US 10-year Treasury is pretty simple. It pays you 4.6 in a currency that's declining by 8, meaning you aren't making 4.6, you're losing 3.4, compounded for 10 years. You give the US government $100,000, and after 10 years, they give you back less than $60,000 in purchasing power. If you combine the weaponization with the weaponization of the dollar by the US government with the fact that arithmetically it's a lousy deal, no real surprise that the foreign central banks are disintermediating out of US dollars and in favor of gold.
And I also believe we kind of talked about this also last time we spoke. There's been since then quite some development as well on that front. How China is leveraging gold and weaponizing gold with the BRICS countries as well, and trying to move away the market from dollar denomination of commodities to gold denomination of commodities. Do you believe first in that trend? And if yes, how exactly would it look like?
Well, it's what I would do, I think, if I was them. You'll notice that when foreign central banks are diversifying out of gold, or pardon me, out of dollars, they aren't diversifying into other currencies. That's because as little as they trust the US, they trust each other less. The Chinese don't want to end up with a bunch of rubles or a bunch of yen or a bunch of euros. Never mind a bunch of pesos or reals or illiquid, unconvertible currencies. Uh, so the idea that there would be short-term settlement between countries in their domestic currencies outside the dollar, but then that currency could be sold on a Chinese exchange for gold, so that ultimately the debt settled in gold, I think has some merit. It has merit until it gets too big. Because once it gets too big, nations are constrained by honesty. There is not enough gold. And those countries do not want to end up with the junk paper that each other issues. There is no government in the world that can afford to go on a gold standard because they all spend more than they take in. And gold is actually honest money. I think what the Chinese are looking to do is reduce the BRICS need to have gold as a medium of exchange. That's very different than ultimately using it as a store of value, because that constrains the issuers of all these bogus currencies. Where would Russia get enough gold to settle their obligations with China and Japan and the European community? Uh, Where would Japan get enough gold to settle their obligations? You get my point.
Well, yeah, if that would be the case also beyond the BRICS countries and more G7, then
Of course.
England and Canada would be in quite enough difficulty as
Well,
well.
Canada would have a real challenge starting, from a standing start. They have no gold.
That's my point. Yes,
Yeah.
they sold all their gold and they sold it actually in the bottom, so that shows how much of great investors they are. But if we look at the way central banks are now, since at least 17 years, being net purchasers of gold and adding to their balance sheets, that just says something, right? I mean, they're doing this for a reason. What do you think they do it?
I think we covered that already. They did it because the former reserve currency uh, was being inappropriately handled. The U.S. government violated that exorbitant franchise by weaponizing the dollar. And the second reason is that the U.S. Treasury is a lousy deal, arithmetically. These foreign central banks aren't doing it out of sport. They aren't doing it because they dislike Trump. Well, maybe a little bit. They're doing it because we've left them no second choice. You know, some years ago, I used to trot around, in particular, Asia, selling Sprott financial products, but in particular, our precious metals trusts to sovereign wealth funds and stuff like that. And I remember very clearly dealing with some what are in effect Asian sovereign wealth funds and looking at their massive holdings of U.S. Treasuries, massive holdings, and saying, as an American, this is very flattering. You guys send us all kinds of cool stuff, cars and computers and stuff like that, and we send you back dreams painted on pieces of paper. I mean, it seems like a really good deal from my point of view, but doesn't it kind of feel, and I said this, doesn't it kind of feel like a lie to you? And I remember a counterparty saying, ultimately, Rick, what you say is true. Oh, he didn't say Rick, Mr. Rule. Mr. Rule, ultimately, what you're saying is true, but yours is a deep and liquid lie, unlike the other lies that we're being told. I asked the same guy, do you trust us? And he said, no, but we trust you more than we trust each other.
That's a good anecdote. If we look at now more monetary policy conducted by the Fed, plenty of analysts and experts warn that cutting into rising inflation and slowing down economic growth would result in stagflation, and that those rate cuts are not beneficial, but they're also kind of the yeah, there's no really other alternatives to also service the U.S. debt. Um, what effect do you see on precious metals? We've seen, of course, gold hitting all times high, silver as well, and other commodities to follow. But if there is an economic downturn, how will this affect commodities?
You asked me two questions there. First of all, when you talk about gold and silver at all-time highs, I don't want to nitpick, but they're at nominal all-time highs. If you use constant dollars, both gold and silver are substantially below their prior all-time highs, and people need to understand that. You're talking about the nominal value of gold and silver priced in U.S. dollars, which themselves have deteriorated very substantially since those former highs were put in. We have to deal with that. Um, but in terms of a rate cut, if you believe U.S. government statistics, which is to say, if you believe that the CPI is an accurate representation of the deteriorating purchasing power of the US dollar relative to a basket of goods and services, there's room to cut interest rates. Mike Maloney refers to the CPI as the CP lie, which is to suggest that it's a very, very erroneous measure of the cost of a basket of goods and services. I would invite your listeners, particularly your North American listeners, to compile a mental index of the cost in US dollar terms of items that sustain their family and compare the year 2020 with 2025. Compare the price of energy, compare the price of groceries, compare the price of rent or home mortgages or health insurance. Pick one. Note too that the CPI doesn't include tax. Try and find somebody whose taxes have gone down in the last 5 years. If you believe that, as I believe, the deterioration of the purchasing power of the US dollar is more like 8% a year. What happens is that declining interest rates increase the negative yield that savers enjoy. Enjoy is a frame I use guardedly. It signals something else to the world. It signals to the world that the U.S. society has decided not to care at all about the integrity of the U.S. dollar. It represents political capitulation and an ignorance of economic reality. I believe, frankly, that short-term politics is more important in the United States than honest economics. So I'm fairly pessimistic about the outcome of a circumstance that you described. I'm not an economist, so I don't know if a weaker economy is nigh, although the oil price and the copper price would suggest that demand is much weaker than people think it is. But I do absolutely agree with your suggestion that if we have a slowing economy, or worse yet, if we have a decline in confidence that would, as an example, spark a 2008 style event, that the policy response to that would be both artificially lower interest rates and massive quantitative easing. And Alexei, it's important to understand that if you or I engaged in quantitative easing, it would be called counterfeiting. We would be put in jail. If Congress engages in counterfeiting, lowering interest rates, they're widely regarded as heroes and reelected. it's it's an odd world that we live in.
It is, and to my point, and on if we look at then commodities just priced in gold, we've seen that up until 2020, it was more or less the price in US dollar and the price in gold, and I'm talking about the Invesco DB commodity index tracker, was kind of on par and following each other. But since the beginning 2020s and then after the COVID lockdown, it started moving apart. The gap created to the point where now, measured in gold, commodities are much, much lower. It went from 160, 140 up until 60. Do you think that gold will either then depreciate and then that ratio of commodities basically reversing to its means, or will other commodities then catch up on gold? And then that question, of course, entails what we've seen now with silver following the big spike in gold.
I think that precious metals continue to run faster. My suspicion, and I'm not an economist, Alexei, I'm really not. I'm a credit guy, really. My suspicion, particularly around the copper price, is that real world demand is much softer than people think it is. In the last year, we've seen 7% of the world's copper supply come offline. Cobre Panama, Grasberg, Kakula, and the copper price is only up 5%. Understanding that prices are set on the margin, a decline in supply by 7% in other periods of time would have yielded a much stronger price rise. My working hypothesis is that near-term demand for industrial commodities, things like oil, natural gas, and copper, in the current period is much weaker than we think. You can have supply shortfalls if you have a demand shortfall, and the price doesn't go up. Pricing it in gold is an interesting topic. I have kept an alternative ledger, informal, myself since the year 2000, where I try to value my income, my assets, my balance sheet in gold as well as in dollars. And if you do that, it's amazing how cheap things are. Your food is cheap. Your gasoline is cheap. Your labor is often cheap. If you measure the cost of goods and services in a medium of exchange that is actually a store of value, bear in mind the gold price in nominal terms is up 12-fold. What you find is that a whole range of things have fallen, in some cases, fairly precipitously in price in the period 2000 to 2025. Unfortunately, most of the people who listen to this interview will be mad about that statement because they forgot to save in gold until the gold price broke out. They were speculators, not savers. I have been, although in hindsight, not aggressive enough, but I have saved in gold for 25 years and I've maintained liquidity in US dollars. Those are very different statements. The consequence of that is not just copper and oil, in other words, not just commodity, but all kinds of things measured in a constant, which is to say gold, are cheap. One could suggest that for many of aspects of our lives, although it feels like we're living in an inflationary period, we're living in a deflationary period.
Sorry to interrupt this episode, but I'd like to tell you more about what we do at Gold Republic. At Gold Republic, we provide physical gold, silver, and platinum, fully insured, fully in your name, fully allocated, in top-tier vaults, securely saved in Amsterdam, Zurich, and Frankfurt. No paper promises, just real ownership, full transparency on your name. We are fully regulated and conduct regular independent audits of our vaults with more than 700 million euros of precious metals under custody and 70,000 investors that trust us in the last 15 years. Our top-rated app gives you full control. Track live prices, explore detailed charts, and buy or sell in just a few taps. Whether you're hedging against inflation, currency risks, or financial stability, at Gold Republic, we offer real assets to safeguard your generational wealth. That's definitely one way to look at it. Now, if we zoom in more on the dynamics between gold and silver, so we just said that long term there's a bearish downside for the US dollar, and that the broader precious metals bull market is just starting, and it starts always with gold and then silver follows. So, what are the, let's say, three strongest tells that there's a handoff from gold to silver leadership that has begun and that you would confirm? And what would invalidate this view?
I've been studying the silver market now for 50 years, and I have to admit that after 50 years, I'm still fairly ignorant about it. I think the difference between me and other people who offer opinions is that I'm honest, and they aren't. My experience, and I can't tell you why, which bothers me, is that after precious metals bull markets always begin with gold. They're always kicked off by the fear buyer. And I would describe the silver buyer as a greed buyer, a different kind of buyer. So the momentum is kicked off by gold. And what appears to happen is that when the momentum in gold justifies in people's mind the precious metals narrative, and the generalist investor comes into our space, that leadership switches from gold to silver, perhaps because of the smaller unit price, perhaps because of its reputation for volatility. And my experience in 3 prior bull markets is that you don't need some fat, bald, old pundit like Rick Rule to tell you when that happens, that the breakout's fairly dramatic. And one would suggest perhaps that the market action that we've seen in silver in the last 5 weeks is just such. The silver market appears to be escalating at about twice the rate of the gold market, although both of them are doing handsomely. I would caution speculators for whom this is their first rodeo that the silver market is much more volatile than the gold market. If you are the type of speculator who would react to a limit down day by panicking and selling out, don't get in the game. There's going to be a lot of volatility and there's going to be a lot of cyclicality. You will see that sort of staccato volatility and cyclicality in gold too, but nothing like you will in silver. So people for whom this is their first bull market understand this is not going to be easy psychologically. And if it isn't easy psychologically, it won't be fun financially.
You said that the rate cuts would put precious metals kind of on steroids, if I'm not mistaken.
It
And
passes prologue. I mean, look back to the decade of the 1970s. In the first half of the decade of the 1970s, the gold price ran from an admittedly price-controlled $35 to $200. And that six-fold increase in price brought in all kinds of people. People who wouldn't own it at 35 were killing each other to own it at 200, which is ironic in and of itself. Inflation became a broadly based concern in the United States, and Congress acted, raised the interest rate, or at least instructed the Fed to raise the interest rate, which they did. And that slaughtered the gold price. People don't remember this, but in the decade of the 70s, in 1975, the gold price fell by half. And the gold equities indexes fell by more. They fell from $200 an ounce to $100 an ounce. Not all, but many of the faithful at $200 an ounce later in the year wished they couldn't spell gold. And by getting shaken out, they missed an increase in price from $100 at the bottom to $850 over 5.5 short years. The lesson here is that gold, I mean, a 50% decline didn't violate the bull market. What it did is it violated the courage of many of the people who had believed it until they were tested.
Oh, you definitely need guts for that. If so, what is different than today with the easing? Let's say compared to also now more recently, 2010, 2011, 2020. Is it the liquidity plumbing or the investor base? What drives that?
I, I think three things. We have a more global economy, certainly than we had in the 70s or even in 2010. The second thing is that the state of the US economy, with particularly regards to debt and deficits and the serviceability of those debts, is in much more perilous condition. If you go back to the beginnings of the equities bull market, 1982, at the end of that amazing period of the 1970s, on balance sheet liabilities of the US government were about 31% of GDP. Pretty serviceable, and the economy was growing like topsy. Now, on balance sheet liabilities of the US government are more like 120% of GDP. In 1982, the net present value of off balance sheet liabilities, Medicare, Medicaid, Social Security, federal government pensions, military pensions, little things like that, the net present value of those obligations was about 100% of GDP. Now the net present value of those obligations is 450% of GDP. So what's changed is one time, but the quantum of the problem is much larger now than then. There was room in 2008, as an example, to have a massive round of quantitative easing because we hadn't had too many rounds of quantitative easing. So there was room to do that without pushing on the string. We see a circumstance right now as we speak where the Fed is buying the near end of the yield curve and doing credit creation in the near end of the yield curve, drawing short rates down, while at the same time long rates are rising. That would suggest that the market is taking control of the long end of the yield curve, not the Fed. The last time this happened was in the Clinton administration. Pretty clearly, things are changing, and pretty clearly, the ability of the U.S. government to manipulate rates and to sustain the fiction of solvency is being tested. Make no mistake, we are liquid right now. There is a lot of cash in the system. There's a lot of individual cash, a lot of corporate cash. Governments can access credit markets right now. But the word liquidity and the word solvency are very different words. It would appear that people aren't concerned about solvency while they're still liquid. People need to refresh their vocabulary, studying the difference between liquidity and solvency. They have to ask themselves that, given the fact that the U.S. government has some money, what is the longer term outlook for their ability to honor their commitments and stay solvent. And I would argue that the probability of that is nil.
Well, I guess it also then explains why a lot of people want to go in scarcer assets like commodities like gold and silver. And talking about scarcity, I'd like to maybe zoom in a bit more about silver and more in particular the the market structure, the supply and the scarcity. So you've highlighted that there's a multi-year deficit. We see about 1.2 billion of ounces of demand versus 800 million mined and around 150 million recycled. But given that most of the output is a byproduct, what realistic mechanism do you think could increase the supply if the price increases drastically? Does, let's say, higher copper or zinc capex come fast enough, or is then this scarcity structurally baked in?
In the near term, uh, it's the reverse. We don't have a solvency problem. There's a lot of silver outside the LBMA and the Comex system. It isn't good delivery silver, but if the price incentives are there, it can be. There's a lot of ground silver, a lot of above ground silver, but there isn't very much in system silver. I was in touch with my former employer, Sprott, where I am no longer an officer director, but I am their largest shareholder. And I asked them to confirm for me that they were able to obtain physical silver for the Sprott Physical Silver Trust and the Sprott Gold and Silver Trust. And they said right now, the North American dealer network, the Canadian dealer banks, have reasonable supplies of wholesale denomination bars. What's missing are the retail denominations. The last silver squeeze, you may recall, or perhaps you're too young, the silver squeeze happened on this side of the Atlantic. We had a shortage on the Comex, and we had a shortage among the Canadian dealer banks. There was ample supplies in London and ample supplies in Switzerland. So we took to, we being Sprott, um, having cleaned out Toronto, we cleaned out Ottawa, we cleaned out Chicago, we cleaned out New York, and we didn't clean out London, but we had to go to London. Now London's out of material. And so the flow of silver is going from North America to Europe. Those dealer banks, not surprisingly, would rather sell silver to Sprott than have to arrange shipment of that same silver to London. Supplies are ample. What is missing is retail denominations. The other circumstance that is amusing to me is that we are in a situation now, I think, where the disparity between the volumes in the futures market and the good delivery inventory available to secure those would appear to be at a crisis point. I have wondered for many years about the interplay between liquidity and solvency in the futures markets, where very frequently, on a daily basis, 200 times the inventory available for good delivery trades in a day. Now, the vast majority of these things cash settle. So we've gone through for a very long time without a difficulty. Now, the traders are holding for delivery because the London price is higher than the New York and the Chicago price. So they're taking delivery and they're shipping that metal to London and pocketing the arbitrage. Now the chicken comes home to roost. I'm not one of those who believes, like the so-called silver apes, that you can have a short squeeze in silver and drive the price through the roof and break the exchange. That's not the way exchanges work. Exchanges are owned by the member banks. If you saw the tin squeeze not too long ago, you understand where this goes if it reaches a crisis point. The exchange shuts down. They arbitrarily set a price at silver and they cash settle. The idea that the shorts are going to catch the banks and drive the price of silver to $250 or $300, um, those guys they're smoking bad dope. That's not the way the exchanges work.
But so how do you explain the pressure on the Comex? You've just said that it's mainly a problem for retail, but not for wholesale, and that those are actually like those supplies are there. But what about the backwardations, the spiking lease rates, and
That's easy. Backwardation is all about the fact that the market believes there's ample supplies for good delivery in the future. Non-good delivery silver can become good delivery silver a year from now, but there's a shortage, a physical shortage right now. The lease rate, the lease rate for silver went from 4.5 or 5 briefly to 40. That tells you all you need to know about the availability of silver. We have, the near-term availability, particularly retail silver. We have a physical market now where most of the smaller brokers, most of the smaller dealers are out of the market. They can't hedge. They don't want to buy. They want to drop ship, and the drop shippers, the hedges are too expensive. You can't fill the market short for 2 days or 3 days or 4 days because the lease rates are too high. So the physical market works at the Sprott level. It works for 2-ton buyers or 3-ton buyers, cash buyers. It doesn't work at the retail level. I mean, suppose you're a mark or one of the real, wholesale drop shippers where you don't maintain much inventory and you're operating mostly off credit and you're filling retail demand in products where there's a premium built into the market. And your cost of capital, at least your leasing cost of capital, the way you've traditionally done business, flooring, is at 40%. That's a very, very, very hard place to be.
So in terms of industrial demand, we've also seen like that's also one of the factors of the silver price increase. I would assume that there's a pool in terms of photovoltaic production, electric vehicles, AI and data centers, electrification, and all that is booming. But you also see investment demand on that side being the kicker. What triggers that switch then from the investment bit?
Markets work in that regard. You will see if the silver price stays high, new fabrication technologies that reduce the amount of silver that goes into various applications. I mean, markets really truly work. You will impact industrial demand for silver. A view a view of the platinum and palladium market and the interchange between platinum and palladium speaks volumes as to the industrial market's response to price spikes. This takes place over time, though. Um, in the very near term, there isn't a lot of substitution that you can do. There isn't a lot of new technology that you can do to reduce the utilization, as an example, of silver as a germicide or silver in photovoltaics. Longer term, markets absolutely positively work. Long term, that becomes you know, a self-correcting problem. The cure for high prices in industrial markets is always high prices. The cure for low prices is always low prices. Silver was very, very cheap in real terms for a long time. And the consequence of that was that there was no particular need in electronics markets to substitute other materials for silver. There was no need in the photovoltaic market to either substitute or to invent fabrication technologies that conserve silver because silver was so cheap relative to, as an example, its reflectivity or germicidal properties. If the silver price continues to go up, what you will see is massive investments in more efficient technologies to utilize silver more efficiently in places where it can't be substituted.
Now, if we look at then the with the gold silver ratio still being quite high, like if we look at the historic long-term medians around 60, and now we're still around 85. Do you treat then that ratio as a signal or as a trap?
I ignore it. Uh, I think it's useful for selling newsletters and generating commissions, but I'm not sure how that ratio, which relates to the material's relative scarcity in the Earth's crust, matters to its utility. Commodities do well when there's more buyers than sellers. And the idea that there's a natural relationship that has to do with the commodity's abundance or scarcity in the Earth's crust without reflecting on their relative utility, or, as you rightly point out, their production cost, given that most silver is produced as an adjunct of copper or lead or zinc or gold. I've never understood for 50 years why the gold-silver ratio was anything that mattered except as a factoid. It matters in the market because it matters in the market. It's very difficult for me to understand how, other than as a psychological factor, it matters at all.
Well, especially if you look at it historically, right, as when silver was still being a monetary metal as well,
Yes.
and had that role, and it decoupled, especially since gold started being monetized. Um, if we now look at let's say the cycle of more precious metals in particular, are we just at the beginning now? Because you just mentioned at the beginning of the interview that if we look at inflation-adjusted prices for both gold and silver, we're still actually not even reaching all-time high.
I believe that the easy money has been made, probably. The easy money, particularly for speculators, is made when commodities are hated, and gold and silver aren't hated anymore. But I suspect that the sure money is ahead of us. If I'm correct that the US dollar, the absolute purchasing power of the US dollar declines by 75%, it makes perfect sense to me that the nominal price of gold, the US dollar price of gold, would mirror the decline in the purchasing power of the US dollar. So I have no difficulty personally seeing a circumstance where over 10 years, the nominal price of gold goes up threefold or fourfold. If you ask the question a different way, Alexei, Rick, what would cause you to sell your gold? That's maybe a more personal question than the one you asked me. Then the answer comes into context. When would I sell my gold? I would sell my gold in favor, as an example, of U.S. Treasuries when there was a positive real interest rate in the U.S. Treasury. Given that I believe that the purchasing power of the U.S. dollar is declining by 8% compounded, I would need to see the U.S. 10-year Treasury with a 10 handle. That would mean that the prime interest rate would be 11. The first mortgage rate would be 11.75 or 12. And that assumes that inflation doesn't pick up. I would need to see a balanced budget, both on and off balance sheet. Right now, the on balance sheet liabilities of the U.S. government at $37 trillion are increasing at about $2 trillion a year. That's a relatively large hole. What most people don't understand is that the off balance sheet liabilities, you're looking at one right here, an old guy, Medicare, Medicaid, Social Security, all that crap. The net present value of those promises is also increasing at about $2 trillion a year. So our debts are increasing at $4 trillion a year. To put that in perspective, gross federal income, all the money that the federal government takes in, all of it is only $5 trillion a year. So before we build a ballroom for the president, or buy a bomb, or send out a Social Security check, or pay interest, or anything like that, before we do any of that, the deficit is growing at $4 trillion a year on $5 trillion in income. So I would need to see that addressed before I made the switch from gold to treasuries. And I don't see it being addressed. You see a lot of chin wagging about this. That noted economist, what's his name, Bernie Sanders, has suggested that the answer is to tax the billionaires. Wonderful rhetoric if you're not a billionaire. You know, that's very popular with people. Get the plutocrats, right? Here's the problem. It's arithmetic. The net worth, combined net worth of all America's billionaires is $6.7 trillion. Never mind increasing their taxes. If you stole all their money, all of it, You solve the problem for 18 months without making a dent in the principal. So I hope that answers your question. I really truly believe that in the context of where we are, past is prologue. In the decade of the 1970s, US dollar purchasing power in an absolute sense declined by 75%. And I believe that the next 10 years will see another 75% decline in the purchasing power of the US dollar. And I suspect, based on history, that that will result in the nominal price of gold increasing to reflect the deterioration in the purchasing power of what you might call the denominator.
And now my last question would be more related to miners, and obviously they've also gained quite a lot of popularity since the beginning of the year. One of the most best performing stocks that even trumped AI stocks for this year were miners. How would you position yourself in the space at the moment?
In a normal bull market, Alexi, the flow of funds goes into the metal. Then the best of the best, the Francos, the Wheatons, the Agnicos, the superpowers, right? Then from there, when they get pricey, it goes to the best of the rest. Then from there, it goes to sort of the producer flotsam and jetsam, the junior producers. This market has progressed much more quickly than any market I've experienced before. Right now, the juniors, at least the high quality juniors, are exploding in price. They're raising scads of money in the aftermarket. The type of speculative market in the gold stocks that you normally would see 18 months or 2 years from now, you're seeing right now. So although I believe the flow of funds will continue to move from the best of the best down the market cap scale, what I have done in the last 3 weeks is I have sold 25% of my junior position by selling 25%, despite the fact that I think they're going to continue to go up. Keyword is think. Uh, I've sold 25% of my upside, and I've recouped all the money I put in the sector over the last 5 years. So I've sold a quarter of my upside, and I've eliminated 100% of my downside. I am putting about half of that money uh, up the quality trail again. In other words, I'm doing the opposite of what I think the market's going to do. I'm buying more physical gold. I'm buying more Wheaton Precious. I'm buying more Franco. I'm buying more Agnico. And I'm putting the other half of the money in the oil business. I'm buying hate, which is something I always love to do.
Clear. So actually, my well, the final message on that would be, you would position yourself on oil because it's the most hated asset at the moment.
I mean, first of all, it's the best business in natural resources. Looking back over 50 years, the best return on capital employed in cycle, out of cycle is oil. It's a really, really, really good business. There's some great allocators there, great technology, and it's hated. It's cheap. Is it going to move in 2 years? I don't know. Uh, Interesting. Now that I'm 72 and I don't have much time left on Earth, I've become much more patient. I think in 5-year terms. And over 5 years, investing in a really good business that's hated has treated me really, really well. So that's what I'm doing. I might look stupid in 2026. God knows I've looked stupid before. That doesn't matter much to me. Late 2026, 2027, 2028. You know, people I think will be talking about my oil trade the same way they've been talking about my silver trade and my uranium trade.
I've actually I forgot to ask you this at the very beginning, but I was curious to know, since you have so much experience in time and the market, more than 50 years, if I'm not mistaken, based on what you're saying, is this the period that is the most exciting to you, or how would you rank it in terms of
The
what's
70s was the
happening?
most exciting because it was new. I mean, I'd never seen it before. And the 70s, well, you would have no memory because you were unborn.
Clearly
Uh,
not.
to watch things like Coeur d'Alene mines go from 10 cents to $65 was mind-boggling. It was truly mind-boggling. Uh, we had a little market in 1990 to 1996 that was for the juniors, the most violent market, and that was fun. What I like about this market was it telegraphed itself. It basically, in 2020, said, ladies and gentlemen, I'm on my way. There is nothing that's going to derail this. It was so easy to see and so easy to describe for people what had to happen and how it had to happen and why it had to happen. And what was even easier was as it began to happen in the bullion, nobody bought the stocks. So there was something that had to go up, that was going up, and didn't have buyers. It was wild. I remember in 2022, there was this huge frustration that the gold had moved, but the gold stocks hadn't moved. And everybody said the sector's dead. Wrong. Gold moved because central banks were buying, and they don't buy stocks. So an asset class that had a buyer went up, and an asset class that didn't have a buyer didn't go up. This was this was the clearest opportunity on the planet. Maybe it was only clear to somebody who'd been batted around in the market for 50 years. But what was lovely about this market was it absolutely positively declared itself. It said, here, there's millions of dollars in the center of the room. All you have to do is pick up, just get up, walk in the center of the room, grab some of it, and go back and sit in your corner.
On that note, thanks a lot, Rick. And yeah, I'm very grateful for your time.
A pleasure. If I might, I would invite your listeners, if they care what I have to say about natural resources, to personalize it. If you go to my website, ruleinvestmentmedia.com, and list your natural resource stocks, please, by the way, no crypto, no pot stocks, no tech stocks, natural resource stocks, I personally will rank them 1 to 10, no charge, no obligation. I'll comment on individual issues if I think my comments might have value. That's ruleinvestmentmedia.com. List your natural resource stocks.
Perfect. I'll put the link also in the description. Thanks a lot,
Thank you,
Rick.
sir. Thank you.